Debt Market Update, May 2021. The fixed income markets moved within a narrow range during the month, with 10-year G-Sec yields ending the month at 6.02%, marginally lower than last month. Support measures announced by RBI during the month: receding of US Treasury yields, rising concern of growth, and ample global and domestic liquidity were the key driving factors. Further, higher than expected dividend by RBI, moderation in CPI, and part rejections of bid in government auctions also kept the yields under check despite concerns over fiscal slippage and rising oil prices. The average net interbank liquidity surplus declined as the CRR was increased from 3.5% to 4% of NDTL from early May 2021. However, OMO purchases and acquisition under GSAP by RBI and soft credit growth vis-a-vis deposit growth kept the interbank liquidity in large surplus. Net FPI flows in debt were marginally positive during the month. On a cumulative basis, in 5M CY21, FPI's net inflows into debt has been $0.2 billion compared to net outflows of $12.5 billion during the same period last year. The Monetary Policy Committee in its meeting concluded on 4th June 2021 unanimously voted to keep the policy repo rate and reverse repo rate unchanged at 4% and 3.35% respectively. It also voted in favor of maintaining an accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. RBI also announced the following measures to support financial conditions. Undertake secondary market purchase through GSAP 2.0 of INR 1.2 lakh crore in Q2 FY22. Further, it announced conduct of INR 40,000 crore secondary market purchases of government securities under GSAP 1.0. Liquidity facility of INR 16,000 crores was provided to SIDBI for on-lending or refinancing through novel models and structures, including double intermediation, pooled bonds or loan issuances, etc. The facility will be available at repo rate for a period of up to 1 year. Liquidity window of INR 15,000 crores with tenor up to 3 years at the repo rates to banks for certain contact-intensive sectors like tourism, hotels and restaurants, aviation ancillary services, etc. Banks are expected to create COVID loans portfolio under this scheme and can park surplus liquidity up to the size of this loan book with RBI at interest rate of 40 basis points higher than reverse repo. Outlook: RBI monetary policy was largely in line with market expectations and yields remained in a narrow range. Monetary policy announcement has potential of infusing additional INR 1.5 lakh crore liquidity in the system through GSAP and other specially targeted liquidity facilities. Thus, financial and monetary conditions are likely to remain benign in the near term. Further, RBI Governor and MPC statement re-emphasized its focus on reviving and supporting growth and looking through the risk of marginally higher inflation. In a constrained demand environment, as seen in the latest GDP data, RBI feels that the near-term upside risks to CPI inflation emanate predominantly from supply-side disruption. Coming to outlook on yields, since the beginning of 2021, multiple domestic and international developments have resulted in overall environment turning adverse towards bond yields. Some of them are surge in crude prices, increase in 10-year US Treasury yields, higher than anticipated government borrowings, elevated core CPI, etc. These have put upward pressure on yields, especially at the longer end of the curve. In our view, most of the factors are likely to persist in the near future and could put further upward pressure on G-Sec yields, especially at the longer end of the curve. Additionally, high SLR holding of banks and signs of broad-based improvement in economic activity can also push yields higher. The risks to shorter end of the curve largely arise from use of longer tenure VRRR operations by RBI, thereby reducing the term premiere to a certain extent. Despite the unfavorable developments, the rise in bond yields has been muted so far, and 10-year yields have risen only 15 basis points since end of December 2020. This was mainly driven by continued RBI intervention through deployment of conventional and unconventional tools. The dovish commentary and future guidance, coupled with systematic liquidity infusion done by RBI, indicates that these interventions will continue in the near future. This should cap any significant rise in yields. Further, comfortable external position, muted credit growth, ample global and domestic liquidity, weakness in growth due to second wave of COVID-19, etc., can pull down the yields further. In view of the above, we expect yields to trade with a marginal upward bias. Hence, we continue to recommend investments into short to medium duration debt funds, possibly in a staggered manner in line with individual risk appetite. While the credit environment still warrants caution, measures by RBI have eased the spreads of AAA-rated bonds significantly. However, opportunities exist in select pockets of non-AAA-rated bonds, as their spreads relative to AAA-rated bonds are still trading at attractive levels. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.